Welcome back to the Deep Dive. We're jumping right in with the January 2nd market snapshot you sent over. Our mission today is to really unpack the core tension defining the start of 2026.
And that tension is everything. It's a market caught between high interest rates and these huge seasonal liquidity shifts.
Yeah, what's the big picture strategy you're seeing?
It really boils down to two things: defense and thematic divergence. Capital is being very, very specific about where it's willing to go. It's a split personality market.
Okay, so let's get into the plumbing of it all, the macro liquidity. The New York Fed's numbers from year-end were pretty wild.
They were. We saw a really notable seasonal deployment. On December 31st, the Standing Repo Facility, the SRF, it borrowed a record $74.6 billion.
$74 billion. So that's cash rushing out from the Fed to relieve pressure.
Exactly. But at the same time, you had the flip side. The overnight reverse repo, the on and RRP, took in about $106 billion.
So huge demand for cash and a huge amount of cash being parked all at once.
It shows the system's plumbing is working, but it's definitely under strain. And that's really just the appetizer. The main course is still the long-term rate environment.
The 10-year Treasury yield, where is that sitting now?
It's holding in that, medium to high band, right around 4.16 to 4.18%.
And at that level, it's just applying constant valuation pressure, right?
Enormous pressure, especially on growth stocks. Your future earnings are just worth a lot less today. And while core inflation has cooled, it's still what the report calls sticky.
So the market is pricing in rate cuts for 2026, but nobody really agrees on when or how big they'll be.
Not at all. That uncertainty is feeding a lot of the caution we're seeing.
Okay, so if money is expensive and everyone's cautious, where is it actually going? This brings us to that thematic divergence.
It's a stark split. You have capital flowing into safety, but also into pure high-conviction growth.
And that growth story is still all about AI.
Absolutely. AI infrastructure seems almost immune to the rate pressure. We see NVIDIA sampled between, 186 and 189.
And then you have the more speculative side of that, like Tesla.
Yeah, Tesla's in the 449 to 455 range. That's a bet on future robotaxi revenue, not so much current cash flow. It's a higher risk play, for sure.
Okay, so that's the aggressive capital.
Yeah.
Now, what about the canary in the coal mine, crypto?
Crypto is showing serious caution. Bitcoin is consolidating around 88.7 thousand.
Which is a strong number, but the vibe is different.
The vibe is very different. The key data point for you here is the Crypto Fear and Greed Index. It's sitting at only 28 to 34.
28? Wow. So that's firmly in the fear range. That's not FOMO.
Not even close. It shows a cautious recovery from extreme fear, but nobody's deploying massive unhedged risk capital there right now.
And that caution is pushing people toward what? The traditional safe haven?
Precious metals, yeah. Gold and silver are absorbing funds for hedging, and the most telling indicator is the Bitcoin to gold ratio.
Explain that one. What's it telling us?
That ratio has fallen a lot compared to mid-year. It means money is actively shifting from the volatile future-facing heads, which is Bitcoin, back to the traditional liquid hedge gold.
So it's a risk preference indicator. Got it. Okay, let's connect all these dots. Key indicators and a recommended strategy.
Right. One last indicator to watch is the weak dollar. The DXY is down around 98.2. This just confirms the dollar's retreat in 2025.
A weak dollar, high rates, mixed sentiment. So what's the actionable strategy for you, the listener?
The synthesis is defense priority, phased entry. You have to have strict risk management. You just can't be aggressive here.
So for a core position.
You want broad-based ETFs. Think VOO for the S&P 500 or QQQM to get that big tech exposure a bit more cheaply. It's about diversified growth.
And for the high-risk stuff like pre-stocks, the report mentions Anthropic and XAI.
Those are for small, purely speculative allocations. The liquidity is dispersed. The price can vary wildly. It's a niche play. The definition of speculative.
Understood. And for crypto, with the fear index so low.
Any entry has to be small, phased in, and you must use strict stop-loss measures. This is not the time for leverage.
So to wrap this up, the market is starting 2026 with a split personality. High caution, but with pockets of intense speculation.
It is. And the path forward for you will be determined by three key things you have to track.
The triad.
Exactly. First, the ongoing use of those Fed liquidity tools, the SRF and RRP. Does that tightness ease up? Second, the monthly inflation and employment data. Obvious, but critical.
And the third.
And third, the Federal Reserve's commentary, their tone. That triad is the steering wheel for the first quarter. And the big question for you to think about is this. Does the sheer narrative power of AI eventually overwhelm the economic friction from a 4% cost of money? That's the battle that will define this quarter.